Eric Wiegand, in the past week, we've gone from a flat S&P year to date to down around 9%. Maybe next week we'll be up 9%. So in your view, where do we finish the year?
You know, from our perspective, looking at the S&P 500, our year-end target is 2,100, which puts us at about 18 times our below consensus estimate of about 117 as far as operating earnings. It's likely to be a volatile ride, as you've certainly indicated, going through, but we still have confidence that the economic data continues to be, reasonably favorable at this point in time, and valuations have certainly become more compelling during the course of the last week.
And how much does China's economy impact ours? I think that was pretty new to a lot of U.S. investors, how a fall in China could really impact our markets. Can you talk about the interconnectedness between our market and China's?
Certainly, and I think you touched on it in the question. It's more a sensitivity to the Chinese economy than it is to the Chinese market. While the Chinese market has been extremely volatile, by and large, very few have direct exposure to the Shanghai shares. The economic sensitivity, though, is more meaningful, particularly as a sense of foreboding towards the overall level of global activity. That being said, the United States is in a little bit more of an insular position. Only approximately 13% of GDP is attributable to trade, so we're not nearly as sensitive to that. It just so happened that there was a confluence of events that transpired. China was served as the tipping point in setting off the volatility that we've seen most recently.
Well, meanwhile, we've seen the yield on the 10-year Treasury fall back to around 2%. Does this reflect what's going on in the U.S. economy? Should our economy merit a 2% yield?
We think we'll actually see yields drift incrementally higher from here. During the height of the fear on Monday, the yield on the 10-year traded down around 1.9%. Today, we're back, nearly 20 basis points above that. There still is a great deal of concern. Expectations as far as more moderate growth have crept into the market, help keeping interest rates low, and certainly a focal point for investors as we move through this month and into September is, what will the Fed do?
And your view is?
Our view is that the likelihood of a change away from the zero interest rate policy that's been in place since the crisis is still on the table, but the prospect of it being changed in September has been significantly diminished.
All right. Now, is there another shoe that can drop out there? We've talked about Greece, we've talked about Ukraine, now we're talking about China. Is there something that we're not watching or that you're watching that we should keep an eye on?
It's a great question. During the course of the last few weeks, we've actually seen things that have fallen off the radar screen come back on. The potential for hostilities between North and South Korea, continued issues in the Middle East. Ukraine and Russia have seemed to fade from the front page to the back page. That can certainly flare up. Right now, I think most investors are rightly focused on is there a response or a change in monetary policy around the world? And clearly, we're continuing to see and hear a lot of accommodation from other central banks, but the focus will be on the U.S. certainly over the next several weeks.
Well, certainly that Chinese devaluation surprised a lot of folks. But my final question is, what should investors be doing right now? A lot of people were at the beach and then they find out that the Dow is down 600, 800 points. What should they be thinking about as they head into the fall and then they start really looking at their portfolios more seriously?
This is a great opportunity to reconfirm the investment objective and make sure they have an appropriate strategy and plan in place. What that entails is making sure that your exposures in the portfolio is really built for all seasons. And that if any exposures became overweight, this is certainly an opportunity to rebalance. We've seen strength in fixed income. If they become underallocated to equities, we think this is an ideal opportunity for them to move back and rebalance that way. And we also have confidence in U.S. equities to the extent that some higher quality shares have become less expensive. The opportunity to upgrade, harvest some losses perhaps, will likely present itself as we move through the remainder of the year.
All right, well, thanks a lot, Eric.
Great. Thank you very much.
And thank you for watching The Street.